Let's go. All right. Happy Monday again. I'm back in the saddle this week. Got away from the garbage truck in Scottsdale. Those things just seem to chase me down for some reason and kind of gets annoying. But what I wanted to talk to you guys about this week was a little more in depth on the real estate market again, but also going through kind of into a deal. We got lots of deals that are on the table. We got lots of deals that are on the fence right now. If you're in bridge debt or short-term debt, there's some problems out there, and that's kind of what I want to lead into. So, guys, if you don't know me, I'm Marc Monday. I own a few different companies that do over $25 million a year. I just basically produce content to help you guys just educate on what I'm learning as a entrepreneur, growing myself each and every day. Like, I'm super into investing in my skills and hopefully helping provide the beginner entrepreneur some skill set so they can learn along the way. And then also, you can find me on LinkedIn, and I provide content each and every day on how to improve yourself. And I also provide a newsletter where it's called Unfollow the Herd. So it's just finding a entrepreneurial path or just kind of a different way to invest, not only in your retirement, but in yourself, so you can have a journey that is not conventional, but very unconventional, and hopefully speeds things up for you a little bit. Because I wanted a lot out of life, and that's a reason that I do this. I expect things bigger than most. I just want a lot out of life, and I know there's a lot of other people out there that want a lot out of life. So that's really why I'm doing content today for everyone in the entrepreneurial world. So make sure to go to LinkedIn, subscribe to my newsletter, guys. I'm pushing that out every Saturday morning. I'm already helping out with over 700 people on that subscriber list. And it means the world to me if you go there and follow me too. So, but let's dive into the real estate market, because it is freaking saucy out there right now with the bank crisis. And I just seen some data come out, but what is happening right now? What economy are we sitting in? Well, there's economic cycles right now, and we've crested over the hill and we're on the downslope, right? So it's just how far do we fall until that thing starts leveling out again? Well, you're starting to see some things break. And when you start to see things break, you're not too far away. And right now, it's unfortunately just like in '08, it's the banks again. So the people that are in the most riskiest assets, tech companies, startup companies, aka Silicon Valley Bank, is in the riskiest asset class, and they broke. They know the people started to understand that they were being insolvent. And Silicon Valley Bank is full of wealthy people. Like, the whole FDIC thing out right now is like, people are only protected up to $250,000 in one bank. Well, that was like 1.6% of that bank was actually insured. So it just shows that almost every person they had in that bank had millions, billions of dollars. So all that money was uninsured. So what happened to that money? Well, if that bank went down, they were just insolvent. They couldn't pay it out. People are doing a term called bank runs, and they knew the bank was getting bad because they weren't able to deliver a withdrawal. Well, when people hear that, or investors hear that, what do? They go for their money. They go for their money now. And they all did this, and they pulled out, I don't know. They called it a $2 billion loss on the news, but we all know it was much bigger than that. And that bank, was basically insolvent. And so the Fed had to come in and protect all these millionaire investors that had cash sitting in this bank. And it was a very good bank. It was like when you closed a note with them, like, they came and had white glove wine with you, and they were a service provider bank. And they're like, hey, do you need credit lines? Of course, it's all high net worth individuals, but they want referrals of high net worth individuals. But it just shows that they were invested in an asset class that was the most likely to break. Not only tech companies, but startup tech companies. So we kind of went over that last week, but I mean, that's kind of what happened. And now you've got other banks in New York, I don't even know. There's handfuls of them now. And basically people are on bank runs. They're worried about these banks. They're going and they're pulling their cash out. It's called a bank run. And now everyone's worried about their community bank. And I've seen Dave Ramsey even post something that, hey, this is happening because these big banks were invested in the wrong assets. And that is partially true. But everyone's pulling their money out of these small community banks thinking, oh man, they're the next person that's up. Like, you know what I mean? Like, you got to go to the flight to safety. So let's go buy some bonds because those are basically risk free. They're backed by the government. And then people go into bigger banks like, Chase and JP Morgan and some of these huge banks that we all know. And people it's just a flight to safety. It's basically, I don't like my cash sitting here, so I'm gonna pull my cash and I'm gonna put it up in this bigger bank because they seem more credible. Well, anyway, this kept happening over and over, right? Like the government sees like people keep pulling out money. People are pulling out money out of all these community banks. And if we have a financial crisis, things are gonna get really bad because then notes will start getting called on real estate and it'll all blow up. Well, to prevent that, basically the Fed stepped in and said, hey, I think they just came out with this morning, we're going to back everyone for 2 years. So basically there's no limit. The $250,000 is now just infinity limit. And I want to make sure that I'm speaking on that right. But that's what I've seen is that they're for 2 years going to protect anyone at any bank. So now everyone is secured. No one has to run anywhere, right? Like there's nowhere, you don't have to go stuff it in your mattress. You can just leave it there. It's insured. If the bank goes to zero, you'll still get your money back. All right. Well, that should prevent a lot of that. And they had to step in. The problem with that, though, is the Fed had to raise their balance sheet by $300 billion. So remember, we're on quantitative tightening, which means the economy is contracting. Instead of printing money, they're trying to get money out of the market space. And by doing this, they needed to reduce their balance sheet. They need to reduce some of their debts, right? So, but they just, all of a sudden we were on the slow tick cycle of down. All of a sudden, boom, now we're back up 300 billion. And it's just, I think them by doing that is really, we're at 6% inflation right now, right? Everyone kind of knows that. And now all of a sudden they basically printed 300 billion. Now, when you print $300 billion, guess what's going to go up? Inflation. That's why it basically puts us back in QE. Now, I know there's a lot of opinions on that, but how can you go and just make $300 billion and not cause inflation to rise? Well, you're not. You're basically, they had to go out and protect all these banks because remember, we're a centralized banking community. We're backed by the feds. It's a very regulated area. It's just not going to help the inflation. That's where we got to get to. So inflation has to come down. We've done a decent job up to this point, but they raised interest rates so freaking fast, fastest as any time in history, all the way from 0 to 5%, which we're going to talk a little more today. This week, they're going to raise rates again by a quarter. And it's just been too painful, too fast. People weren't ready. I like to use the term fat, right? Like everyone's just running around with money because money's everywhere. Well, what happens when you get fat is you start not taking care of yourself. You start just doing, spending money needlessly. And this happens in business too. Like people get fat and things just don't, you're not tracking things as you should be because there's plenty of money out there, right? So, and then it's kind of like the whole thing, like when you're swimming naked out there and the tide comes back, right? Like you're just not paying attention and now the tide's coming back and here you are standing naked and broke because you didn't watch your finances. So I always like that analogy, but it's so true because now you're seeing the Fed have to step in now and print more money just to cover these bank deposits. So, and what I'd like to tell those people is you shouldn't have multiple millions in the bank. You have a business, you have a job to make money. Now, where does that money need to go? It should be pumped into something in investment, right? It should never sit at the bank and just earn, unless you need it for cash flow operations. But no one needs $10 million or $3 million or, in the bank just as most people, I should say. Not everyone. Most people don't need that much money in the bank just to have in an operating account. I get that. Why is all the other cash just sitting there? You should have it somewhere, right? More than even a high yield savings account. That's only getting you 4%. Well, and when inflation's 6 and potentially going up in the next few months, what then, right? Like you need to put them into, like, I get rid of all my cash and I put them into assets, and I put them into real estate. I put them into a new development. That's just what I do with my cash, because I love the tax benefits of real estate and I love the capital preservation, because it's very low risk. When banks love lending on real estate is because it's a low risk asset, and it's a great hedge for inflation, and it's a great place to store money. Now, I know there's lots of people out there with, hundreds of thousands, millions, even tens of millions of dollars just sitting in the bank. And it's like, you need to get that to work for yourself, because realize if you're getting 3, 4, 5%, inflation's probably 6. Maybe they're lying. Maybe it's more like 10. Right now, you're getting eaten alive. Your cash is literally evaporating faster than you can protect it. And now as the 10-year comes down, the 10-year treasury is coming down because everyone's the flight to safety. Remember, people are moving from cash into bonds because bonds are safe, but it's the lowest return on your investment. A really horrible real estate investment can be a 10% return on its life, or an internal rate of return. And usually you'll get much better than that, even up to 20%, not including all the depreciation you get. So that's why I take money I make in my earned income. I store what I need in my operating accounts and what I need on hand to protect myself in reserves. But then I move all my cash literally into assets. And I didn't realize this till like 5 years ago, 6 years ago, when I really started diving deep. Like, what I really did is I searched, like, what do the super wealthy invest in and why? And you can ask ChatGPT this, you can ask anything. But what you find out is everyone's investing in real estate. So it's like, why, right? Like, well, because they can make millions of dollars and store them in a appreciating asset. I mean, think about what you own right now. Just think about all the stuff you have. What actually goes up into value? What do you have that goes up in value? Is it, maybe my TI 83 Plus is going up in value. Maybe. I mean, it's ancient and they still sell the same one, but not likely, right? It's going down in value. This iPad, I know that went down in value. I have a watch. Some watches might go up in value. That's true. But not likely, right? Like, most of the stuff that we own is going down in value. There's not many things. And most people, the most common answer you'll get is, what do they say? Their house. It's like, not a good one either, right? Unfortunately, the government sees your house as a liability because it doesn't make you any revenue. It just gives you a place to live. So if you're storing all your money in your house, I would make sure that you get a home equity line. Now that the interest rates suck, right? Now it's harder, but shit, a year and a half ago, I went out and got a mortgage. Who wouldn't get a mortgage at 2.25%? Like, do I have a better chance at making more money than the 2.25% is going to charge me? Hell yeah. Like, I didn't know anything on my house, and I thought that was the life dream, because it's the American dream. It's what we're taught. It's following the herd. And then I realized, no, all the wealthy people use leverage to their ability, because even when you can borrow money at 6% and inflation's at least 6%, what's your interest rate? What's your ideal interest rate, right? Well, in 2 years, is that loan going to be easier to pay down because our purchasing power is going to go so much further down? The value of the dollar is going to drop again. And it's already dropping. We need it to drop. But just understand that's kind of where I started at my career path in real estate. And like, that's why the super wealthy do it, is because they get to invest in assets with awesome capital preservation. It's not get rich quick. You're not going to make a bunch of money today. What you will get today, though, is a tremendous amount of tax benefits. As a real estate professional, you get so many tax benefits, and you can own all sorts of different companies, and you can get sheltered by the depreciation on a large asset. And maybe we'll go into more what being a real estate professional is next week. But I told you that we would go further into a real estate deal, and I just can't do that easily on a podcast. So what I'm going to do is I'm going to shoot a YouTube this week, breaking down a simple real estate deal. So like, if you don't understand a simple, like I get so much terrible numbers sent from me, like how here's the income. It's, the pro forma sent from the realtor, it's a duplex and it's $1,000 a side. All right, my rent's $2,000 a month times 12. It's 24 grand. No, there's people that move out. There's other ways to get more revenue out of the project. The duplex, and you just have to like just understand that like people just don't know what they don't know. They didn't hire coaches, mentors. They didn't have a perfect spreadsheet. They don't understand all this. But I need to explain this in depth in probably a 10, 12 minute YouTube video. I'm going to break down all the revenue sources. I'm going to break down all the expenses that you possibly will have, and some that you probably don't even see coming because of all this inflation that's happening. You got utility expenses up. You got I'm just looking at my real estate taxes. It's like your percent change in your asset was 49.54% increase for your real estate taxes. Well, this is a property I own. Literally in Thompson, went from $270,000 to a valuation of almost $400,000. So you have to understand why those are coming, right? Like real estate taxes are increasing, but some people don't think about that in their pro forma or their metrics. So I'm going to break down in this YouTube basically everything that you can see as a beginner you would need, probably even a little more than even a beginner would need on where to start. And then also on my newsletter, I will release like a calculator, an analysis calculator. So you can just take simple deals, run the math, see if they even work. And if they do, then you can buy them yourself, or maybe you can hit us up to partner with you on a deal. But I want to partner up with some of you guys on your real estate deals. If you have larger ones that say you're looking for capital, maybe you're just looking for a good partner because you don't know exactly what you're doing, but you think it's a good deal. We can run it on our side and tell you, so I'm just out here trying to provide a lot of value to you. I think I can do this better in a YouTube than say, on this podcast, but there's lots of things that you need to pay attention you need to pay attention to right now, because you could get into a lot of trouble. I always hate seeing people go into real estate deals because they love it. They get married to the deal, but the numbers never make sense, right? Like you don't want to get into a bad deal just because you love it. The best deals, I always say, smell funny. They look weird. They have mold. Whatever thing that they can have that looks terrible, those are the best deals, to be honest, as a real estate investor. I don't want the thing that's been flipped and looks nice and has perfect new flooring, because all the delta's been taken. Someone's already made their money. So anyway, keep out for YouTube. And if you haven't subscribed to me on YouTube, please go. Just search my name, Marc Kuhn. Freaking subscribe to me. I will have this posted in a week or two, a video on how you can do it yourselves. And like I said, if you want to team up with me, reach out to me on LinkedIn, reach out to me on Instagram here, Facebook, whatever, and we'll help post. And I don't know if any of you have questions, please ask me a question on Sundays. Jen, I don't know if there's any questions. There were none today. Okay. But hopefully this was helpful on where the market is and why the banks are collapsing. Guys, we're in all-time credit card debt right now. There's freaking car loans going. Basically, you're starting to see them just default. I mean, that's just what's happening. We're in the economy of downhill. I wouldn't protect all your money in banks. I wouldn't keep a lot of cash in banks right now. It's not earning you enough. Protect yourself in assets, capital preservation, and real estate. I hope to help many do that. And hopefully I can help provide a way for even you to get into real estate. So any other things, guys, hit me up with a question.
How can one get into that? Do they contact?
Get into real estate.
Yep.
So reach out to me on LinkedIn or Instagram. Just leave me a DM, and then I will reach out to you, and then just say, I don't really want to do a coaching program, but I want to see how as many ways as I can help provide as much content as possible. So if you want to reach out for help on Instagram, just DM me. I'll see how I can help you, invest in your own deal. If you have a deal, DM me the deal again. I'll probably give you my email and you can send that to me there. And if everything goes well, I'll reach out with my phone number and we can connect. So thanks so much, guys. I appreciate you. We'll see you on the next one.